Now, finally, this is time to go to the weighted average cost of capital. Finally, yes, yes. Now, let's see. Weights of the cost of capital computation. In computing the cost of capital for publicly traded companies, the general rule for computing weights for debt and equity is what you use. Is that you use market value weights, right? And not the book value weights. Okay. Why is that the case? Why should it be market value based weight? Okay. Choose one of the followings, right? A, because the market is usually right. B, because market values are easily obtained. C, because book values of debt and equity are meaningless. D, none of the above. What's the answer? If this kind of thing comes up in your exam, what's the answer? The answer is none of the above. Okay, none of the above. The answer is what? Because we take the perspective of the market investors right now, okay? The objective as a CFO using this weighted average cost of capital, and the objective of the CFOs doing this valuation exercise is because he or she wants to raise capital in the market right now. So she has to take the perspective of the market investors right now. So the weight that you use in this setting has to be the market value based weights. Okay. All right. Weight of wait a minute. Yep. The weights for cost of capital calculation, WACC calculation. The weights, right, used to compute the cost of capital should be the market value based weight for debt and equity, and the market value of equity should be market cap, which is share price times the number of shares outstanding. The value of debt is usually more difficult to obtain directly. Okay, there is an element of circularity actually, right? Circularity. The students get confused over here. Okay, what do you mean circularity? 꼬리에 꼬리를 무는, like a chicken and egg kind of things, right? Circularity. That is introduced into every valuation by doing this, right? Since the values that we attach to the firm and equity at the end of the analysis are different from the values we gave them at the beginning. What are you trying to say, Andy? Please, element of circularity. Well, let's take a step back here. Okay. Our original goal of doing all this kind of mess, right? What is the original goal, right? We are trying to estimate the true value of the company, right? True value of the company, market value, true market value of the company. Is it observable or not observable? True value. Not observable, right? That is not observable, true value. But we want to estimate it. That is our goal. Of course, the value of the firm, let me write it down over here. Value of the firm, okay? Value of the firm. That's something we want to get at, okay? And then if you look at the balance sheet, value of the firm should be value of the asset, left-hand side of the balance sheet. Make sense? Yeah. And then balance sheet identity says what? The value of the firm should be value of debt and value of equity. Okay? Or should I say, I should write it this way. Market value of asset, right? Equals to market value of debt plus market value of equity, right? All these things, actually the true values of all these things are not observable. If these things are observable, why are you here? You should be Warren Buffett by now, right? Or better than Warren Buffett. We can't observe this, okay? That's why we are trying to estimate it and make money out of it, okay? Oh, didn't you say market value of equity is like market cap, Andy? Yeah, that's just our starting point. Market cap or 시총, market cap. Okay, 시총 kind of things is based on what? The price times number of shares outstanding. Shares outstanding times price. Okay? Price per share, is it observable or not? Price versus value. Which is observable? It gets back to this idea. Price is observable, whereas value is not observable. I told you before, right? And this guy is something observable, price, right? And then we are computing 시총 or market cap based on this observable price. And then we are taking this market cap as market value of equity. Okay, the true market value of equity, we cannot observe it, but market cap is observable, and we are using it as a replacement for our convenience, right? For the sake of convenience, right now. Okay, so I'm trying to talk about this weight used in WACC calculation, right? WACC calculation. Right? For this WACC calculation, we need the weight of equity and weight of debt. Right? All these things, weight of debt and weight of equity, that has to be market value based weights. Okay, market value based weight. So weight of debt has to be market value of debt over market value of the asset. Okay? Now you see the trouble, okay? Now you see the trouble. Can you observe true value of market value of debt, and can you observe true market value of asset? And the answer is no. No. Right? So to be strict, you cannot even start to compute WACC because you don't have this true value based weight of debt and equity. Right? But you need to start somehow. 안 되면 되게 하라, right? 특전사 kind of mentality. If you cannot, if it is impossible, try mission impossible and make it your way. Somehow, do something about it, right? We need some starting base, right? 안 되면 되게 하라. How do you do it? Well, let's take market cap as our starting base of market value of equity. We are not claiming that market cap is a true value of equity. We're just using it to compute WACC, to compute the weight of equity, right? And then, so market value of equity, just get a proxy, right? Starting with market cap. And then market value of debt, cannot observe it, but you have some alternatives, right? You have some alternatives, which is called what? Book value of debt. Okay, book value of debt. It's better than nothing. It's better than having nothing, right? So use that, right? Then this guy will be taken care of. Book value of debt used as a proxy for market value of debt. And then market value of equity. Yeah, I said market cap. So you can compute market value of asset to get the weight of debt and equity, right? So that you can get weighted average cost of capital. So based on that weighted average cost of capital, what do? Get the present value of free cash flow to firm and then estimate the market value of asset. Okay, that the estimate of market value of asset, MVA, okay, MVA estimate. That's something you estimate using MVA estimate using some free cash flow to firm, or cash flow, I would say, cash flow to firm. And then WACC minus G. You see that? So this one, you got it, from this, all inferred from the market value of debt and equity, and then based on the market value of asset, right? 안 되면 되게 하라 kind of market value of asset. And then you finally estimate the market value of asset. So this is a circularity. 안 되면 되게 하라 kind of, it is kind of a quick and easy way of market value of asset you used to compute the WACC. Your end goal was to estimate the market value of asset. Huh? Isn't this asset that we wanted to get at in the first place? And then circularity goes on in this sense. Okay, so that's the basic argument over here. Okay, to estimate the market value of equity, to estimate the market value of asset, we need to start with market value of asset. What? And then back and forth, this kind of trouble goes on. So there is an element of circularity that is introduced into every valuation by doing this. Since the values that we attach to the firm and equity at the end of the analysis are different from the values we gave them at the beginning. Okay, so as a general rule, the debt that you should subtract from the firm value to arrive at the value of equity should be the same debt that you use to compute the cost of capital. Now, put it easy, right? Book value of debt will be your good proxy for the market value of debt. Okay, so that's that. And then tax rate. So circularity issue, by the way, circularity issue. How do you take care of it? Well, start with market cap and book value of debt, and that's it. And forget about the rest. Okay, you estimate the market value of asset with this WACC, but that's good enough. So what if the market value of asset that you computed is different from the market value of asset that you start with? That market value of asset. It will be different. That is what the valuation is about. Okay, so just live with that. It's okay. Tax rate. The choice is really between the effective tax rate and marginal tax rate. I told you about it. Marginal tax rate has to be there, right? Right. And then dealing with preferred stock. Well, if there should be some preferred stock, go ahead and do it. But if it is the market value of preferred stock is less than 5%, right, of the outstanding market value of the firm, lump it into debt, and then make no significant impact on it. Just treat it as if it is debt. Okay, if it is just small enough of a amount. Why is that the case? Because the preferred stock dividend, okay, that's something those managers, those CEOs have to pay no matter what, almost, right? Of course, you can forego dividend payment even for preferred stocks. In this kind of depression coming up, okay? The other day, JP Morgan announced, by the way, JP Morgan announced that they may have to skip dividend or dividend for common stocks, okay, going into the future, because their business prospect going into the future, it looks very dismal. Okay, so common equity dividend, they skip it, and depending on the business situation, business cycle, right? Preferred stock, well, less likely. Okay, this is the stock that you just pay out, right? Instead, the preferred stockholders, they don't have voting rights. So by sacrificing their voting rights, they get cash claims of dividends, right? So that's why it is very difficult to cut the dividend for preferred stock anyway. So it is more like interest payment. So why don't we treat it just like a debt? That's the idea going on over here. Okay. Yes. So that's that. Recap, the cost of capital should work like this, right? Cost of capital, or WACC, should be the weighted average of the two things, cost of equity and cost of debt, right? Of course, cost of preferred stock could be there, right, as a third element, but ignoring the preferred stock, right? This should be it. And then the cost of equity, well, based on bottom-up beta, will be the most preferred one. And then cost of debt, well, cost of borrowing, in case it does not have a, in case the company does not have bond outstanding, synthetic rating would be it. And then attribute those default spread, and then cost of borrowing, yeah, you see that RF plus default spread. Of course, plus your country's default spread proportionate to the sales breakdown. Now, market tax rate reflecting the tax benefits of debt, 1 minus tax rate has to be there because of the interest tax shield effect, right? And then the weight of equity and debt, it should be market value based, of course, right? And then preferred stock, right? In case the preferred stock is non-trivial, right? Non-trivial, what should be the cost of capital for preferred stock, RP? Well, usually the dividend for preferred stock divided by price of preferred stock. Simple and easy way. All right, that's it. Yeah. And then estimating cost of capital for Embraer in our example, cost of equity 9.45%, market value of equity, you get it in the market cap, right? And almost $8 billion, and debt, cost of debt, you computed 9.29%, and market value of debt 713 million US dollars worth. And then cost of capital should be based on these market values of debt and equity and cost of equity and debt, and the tax rates you compute it to be 8.92% if you do the math. All right. Now, once you do that, yeah, the practices of estimating cost of capital, this is more self-explanatory, so you can read it off, right? And then and then some more thoughts about thoughts and questions related to this. Firm value and equity value. Well, that's something is coming up to you, okay, and estimating whether you should estimate value of equity first directly, or you first estimate the value of firm and then subtract the debt value as an indirect approach to get the value of equity, right? The choice is yours. To get the firm value to equity value, which of the following would you need to? Okay, A, subtract out the value of long-term debt. B, subtract out the value of all debt. C, subtract the value of any debt that was included in the cost of capital calculation. D, subtract out the value of all liabilities in the firm. Well, clearly D is not the answer. Okay, A is not the answer either. You have short-term debt as well. Subtract out the value of all debt. Well, either B or C should be clear. This is the answer, right? Both of them make sense, right? All debt should be included in your cost of debt calculation, in your weighted average cost of capital calculation anyway. So B or C should be the answer, okay? In your exam setting, there would be no confusion like this, right? B, C, two answers at the same time. Don't worry about it. Doing so will give you a value of the equity, which is A, greater than the value you would have got in the equity valuation. B, less than the value you would have gotten in the equity valuation. C, equal to the value you would have gotten in equity valuation. So which one would be the answer? Well, in theory, right, in laboratory setting, you will get the same equity value, whether you get direct approach market value of equity estimation or indirect approach of first getting the firm value and subtracting out the debt and get to the market value of equity. You should get the same value in theory. but in reality you will get different values, right? So that's the thing you have to think about. Okay, you don't have to worry about, by the way. Yeah, one can give you some upper bound, the other can give you some lower bounds depending on the situation. And then cash flows and discount rates. Assume that you are analyzing a company with the following cash flows for the next 5 years. So market value of equity that you estimate using two different approaches. Would you get the same value is the question of the next slide, right? In theory, you should get the same value. Okay, so what's that? Let's see. Let's see. Here you have 5-year time horizon, and then after 5 years, you're going to have infinite life, stable growth, and there will be some terminal value associated with it. Now, cash flow to equity is there in the second column, 1, 2, 3, 4, 5, and then interest expense each year after tax is there for you, $40 all the way down, and then cash flow to the firms, 1, 2, 3, 4, 5, which is the cash flow to equity plus cash flow to debt holders, right? Assuming that this interest, after-tax interest expense, is the only cash flow going to the debt holder's hand, right? Forget about the debt repayment. Let's say this is perpetual debt or something. Okay, so the cash flow to the firm will be the addition of these two items, right? Now, the terminal values, right? Both equity cash flow and firm cash flow, they will have their own terminal values like this. Now, assume also the cost of equity is 13.625%, and the firms can borrow long-term at 10%. The tax rate for the firm is 50% for our calculation. The current market value of equity is what? 1073, and the value of debt outstanding is 800. Okay, so what? The method 1, discount cash flow to equity at cost of equity to get the value of equity. This is a direct estimation of market value of equity. So cost of equity is 13.625%. What's the value of equity that we estimate? Well, discount all the cash flow to the equity at the cost of equity. Yeah, be consistent. Over here, you get 1075, right? By the way, how do you get the present value of your free cash flow over this horizon, right? Using this financial calculator, right? So here, the calculator is here for you, okay? So what do I do? Shall I go down here? Can you see me? All right, so up over here. So what do? Turn on, yeah, at least punch in, and then cancel everything. The function that you're going to use is what? This cash flow function, CF. Do you see CF? CF? Right, this takes care of fluctuating cash amount going into the future, right? And the moment you punch in the CF, you see CF0, which means the cash flow today, right now, 0 point, okay? The origin 0. So right now you have no cash, no problem. The value of your stock has to be about the future cash flow 1, 2, 3, 4, 5. So you scroll down using this arrow, okay, cash flow. Oh, before you punch in this cash flow, by the way, let's clear everything in case there is some memories going on. So second, right? And then clear work, second clear work over here. Yes, and it wipes off all the memorized things in your calculator. And then cash flow, right? Punch in cash flow, and then the first cash flow is what? 50, and then enter, right? Enter, punch in, and then the second cash flow 60, right? Wait. Did I say cash flow 0? No. No. Cash flow 0 has to be 0. So, sorry about it. Don't make this kind of mistake. So, cash flow, you punch in, and then you see this, it is memorized as 50 as cash flow 0, which is a mistake. So, you want to delete all these things. Clear the work. Second, clear. Right, it becomes 0. I'm happy with that. All right. So, what do? Punch in 50 as a cash flow 1. So first scroll down to see cash flow 1, C01. Okay, so that's 50, and then enter it. Make sense? Can you see it? Yes. And then scroll down, you see F01. What the heck is that? And it says 1. That means frequency of cash flows of 50 happening since cash flow 1. How many times does this 50 cash flow repeat itself going into the future? Just never repeats. It's just one time happening cash flow 50. So 1 is just okay. Okay, so we scroll down, right? If 50 cash flow happens 2 times, okay, year 1 and year 2, you could punch in 2 for F01, and then move down to cash flow 3, which over here will look like C02. Okay, but that will be a little bit confusing for you right now. Forget about it. Right now, start with this 50, and then punch in enter, and then frequency 1, and then scroll down, and then cash flow 2. This is 60. Okay, so cash flow 2. 60, right? And then enter. Yes, there we go. And then scroll down. You see, check your frequency of this cash flow happening just one time. That's good enough. Scroll down. Cash flow 3, that is 68. 68, enter, right? And then scroll down just one time. That's good. One more time. You punch in the scroll down, you get to cash flow 4. That is 76.2, right? 76.2, that you see it over here, and then punch enter. All right, scroll down, frequency just once, and then scroll down one more time. You see 5th year's cash flow, okay? 5th year's cash flow, what should that be? Not just 83.49, but its addition to terminal value of 1603. Okay, so 83 plus 1603, 0.49, yeah, should be this guy, 1606, right? 0.49. Make sense? Did I punch it correctly? In case I made a mistake, or is it, did I write, oh no, not 06, but it's 86, so I was right. Okay, so fine, I'm safe. Now enter it. Don't stay happy simply because you got the right number at this stage, because I did not punch in enter. So enter. Okay, it ain't finished until it's finished, right? So that's cash flow 5. Cash flow 5, well, how many times does it repeat? Never, just once. And then cash flow 6, forget about it. It's just a 0. Okay, fine, just to scroll down. And then punch in, scroll down 2 more times, you will get to cash flow 0 again. You can double check what you've punched in over here by scrolling down, and then have some fun with that. Okay, like this. You're happy with this. Now what do you do? What you want to do is get the present value of it. How do you get that present value? Well, here you see NPV key, right? Net present value key. Punch this guy, okay? NPV. Net present value, yeah, it is essentially present value, okay? Here, you need some input. You have cash flow input already. So this guy is asking you to punch in the discount rate. What is the discount rate over here? The cost of equity, which is 13.625. Okay, 13.625. Here you have to punch in the percentage figure instead of decimal places. So 13.625 should be it. Don't stop there. You have to enter this guy. Okay, and then scroll down, and it says NPV, right? Right now, by default, it says 0000, which means I did not calculate anything right now. I want you to punch the compute key over here. Okay, CPT, compute. And it gives me this, 1073.000651. And that turns out to be this number, 1073. Right, so we are happy. Okay, so free cash flow and computation is done. Well, that's good. So that's how you use your calculator, by the way, and get the present value of cash flow to equity, and you get the market value of equity using this cost of equity. Okay. The second method, is indirect approach. Remember, the first approach was direct approach. Directly estimate the present value of cash flow to equity, get the present value, market value of equity. Second approach, indirect. Why? First compute the present value of firm, and then subtract out the market value of debt, and finally get to the equity value, market value of equity. So for this part, not only you need firm value, firm cash flows, right? But also you need WACC, weighted average cost of capital. So cost of equity is there, 13.625%, and the cost of debt is there for you, 5%. And then remember what? Wait a minute. Cost of debt is 10%, but it has to be 1 minus tax rate, which should be 5% in the end. So based on these two figures, you can compute the weighted average cost of capital because you have the weight of equity and debt in the first place. Right. So weighted average cost of capital should be 9.94%. And then you can compute the present value of your firm using the financial calculator yourself, right? And then do the computation. You get the present value of the firm, not the equity here. Don't stop here. So many people stop here and get some points off. I told you there are infinitely many ways of screwing up your life. This is one of the ways to do that. Don't forget to subtract the market value of debt. Okay, so the market value of debt 800. Subtracting out from 1873, you get 1073. Wow! Lo and behold, okay, in this example, in this fictitious example, you get identical numbers, right? For market value of equity that you estimated. Okay, in theory, things may work like this. Okay, but this is a very fictitious, made-up case for you to tell you that in theory it works. Okay, whether you take indirect approach or direct approach, but in practice, it never happens. Okay, don't worry. We are supposed to get different results anyway, and as a consumer or as a reader of your analyst reports, the readers have to be critical about why did you choose to go for direct approach instead of indirect approach. You wanted to get some higher bias or lower bias result. That's what you're doing. Okay, and you have to defend yourself. Oh, that's not blah, 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 blah. So that's what we are trying to get at. Okay, now principles of valuation: never mix match cash flows and discount rates. So that's the next key takeaways in doing WACC valuation versus equity valuation. Okay, the key errors to avoid is mismatching cash flows and discount rates. Since discounting cash flows to equity at the weighted average cost of capital will overestimate your equity value. Why is that the case? Why is that the case? Discounting the same equity cash flow but using WACC will overestimate your equity value. Why? Think about the WACC versus cost of equity. Which one will be higher? Which one will be lower? Cost of equity will be higher. Cost of capital will be lower because weighted average cost of capital should be the average between the cost of equity and cost of debt. And cost of debt, should it be bigger than cost of equity or lower than cost of equity? The debt is safer than equity. Why? Because, as I said before, it's legally protected, right? Creditor's right is there by law. So the cost of debt will be lower than cost of equity. So the average of these two has to be something in the middle, not above, of course. So that's why WACC will be lower than cost of equity. So if you discount the cash flow to equity with this WACC, you will overestimate the value of equity. The same thing, the flip side of the same coin, okay, is that if you value the firm, okay, value the firm, and take the indirect approach, right, to get to the value of equity, right, value of the firm, discount the cash flow to firm, and discounting at cost of equity will what? Overestimate or underestimate your value. Which one do you think? Quite confusing, right? You should use WACC, but if you use cost of equity, you're going to underestimate the value. Why? Again, cost of equity is bigger one than cost of capital, WACC, right? So that's why. Who makes this kind of mistake? You will say it. But every now and then, people make this kind of mistakes. Even your boss will make this mistake, right? Based on those fictitious example, right, in the previous slide, let's see what happens if we mix match this cost of capitals, right? So error number one is a discount cash flow to equity at cost of capital, WACC, to get the value of equity, right? What will be the result? Well, you overestimate the value of equity. You see 1248 as a result when you use WACC instead of cost of equity. You're overestimating by 175. Error number two, discounting cash flow at cost of equity. Discounting cash flow to firm at cost of equity to get the firm value. Well, your value of equity will be only 813, which will be underestimate of your value of equity, okay, by 260. Error number three, discount cash flow to firm at the cost of capital, and forget about subtracting debt, right? You will also have some trouble over there, okay? So that's all kinds of mistakes. I mean, not all, but some of the major mistakes that you can make, right? Don't get confused. A lot of things to be tested over there. Good. Who makes this kind of mistakes? Who the hell, you may say. But everybody can make mistakes, right? There's a famous Harvard case study, well talked about, okay? That was the mistake done by Harvard graduate investment bankers in Morgan Stanley, right? Top investment bankers, how could they make mistake? They can still make mistakes. The trouble is, the consumers of this kind of reports, they had to be able to detect what was going on over there and then identify, oh, you made a mistake over here. Correct it, please. You have to say that. Here's the story here, okay? There was a company called what? The Kennecott. And then there was, what is that? Kennecott was a company in the mining business, if I remember the story correctly. And then this Kennecott, right, this company, all of a sudden they won a what's that? Not Nobel Prize. Come on, the lawsuit, right? A sudden lawsuit, and then after winning lawsuit, they got a windfall of cash coming into their pocket. Okay, was that amount about $600 million or something? All right. All of a sudden you got so much of a cash, $600 million, right? And then if if you're the CEO of this company, what should you do with this cash windfall, right? First of all, you will try to find out some investment opportunity, right? Good investment opportunity. Look around, and then in your business, in your industry, is there any good investment opportunity of mining something, right? And you find nothing. Okay, positive NPV project. Is there anything? You can't find it. Okay. Well, in that case, what do you do? What do you do with this excess cash? Reinvestment. I said there's no positive NPV project. Okay, this is pretty much mature industry. What would you do? Well, you have to distribute it to the what? Shareholders in the form of dividend. Here is a dividend for you. Okay, we got excess cash. Not knowing what to do, the best way is to redistribute it to the shareholders. Thank you, thank you, thank you. Here you go. That should be it. That should have been it. But what did these guys do? They went to the investment bankers, right? Called what? Wasserstein Perella or something? Or Morgan Stanley. There was a guy called maybe like Pirella somebody, right? And then he talked to this guy, investment banker. Please, you are best M&A advisor. So please advise me to find me some good acquisition target so that I could take over those company as an investment, right? And this is like bringing your money to the bringing your money to the plastic surgery and then say what? Oh, what's wrong with my face? And then the plastic surgeon will always say what? Oh, everything is wrong with your face, man. And then give me the cash, right? And then they will, find whatever reason for you to spend that money out, right? So this investment banker, right, identified one target called carborundum, and then they evaluated this company, the valuation, okay? And then the funny thing is, right, they did what? What is that? They were coming up with this cost of equity and then weighted average cost of capital for acquirer and target, right? And combined as well, okay? Cost of equity and then cost of capital for both acquirer and target and combined entity, right? And you see that on this yellow table over there, okay? You see which one is highest and which one is the lowest, right? By the way. And then valuing this target, right? Carborundum, right? They obtained the what? Free cash flow to equity. Free cash flow to equity, direct method, right? Direct method. And then they discounted at weighted average cost of capital of the acquirer, right? Which is turned out to be the lowest of all. And then by that, they came up with this nice value of $600 million. You said that you got $600 million. Here's exactly what it's worth, right? You spend it over there, and then proportionately, you pay me the fee. Yeah. So they did it, and then the CEO of the acquirer got screwed up. Okay. The shareholders got pissed off, and then, yeah. So that kind of mistakes happen, right? First of all, as long as this was free cash flow to equity, which one do you have to use? Cost of equity or cost of capital? Cost of equity to be consistent, right? But they used WACC, which is inconsistent. That's the key mistake here. And number two, as long as you are valuing the target, right? Whose cost of equity do you have to use? That has to be the target's cost of equity, because you have to be consistent with the cash flow, right? Why do you use cost of, anything of the acquirer, right? It has to reflect the riskiness of the target company in the first place, right? Regardless of the acquirer in the first place. So that is, the most important, these two important things in valuing M&As, right? Later on, let's see if we can touch on this M&A valuation later on. So that's the thing for now. And then a lot of mistakes happen over there in the investment world. As it turns out, right, this M&A advisor, okay, supposedly Morgan Stanley top investment bankers, right, they still make this kind of mistakes, right? But the issue is the acquirer CEO, right? Why didn't he capture this mistake and then tackle on this issue and then correct it, okay? Instead wasted the shareholders' money, okay? So that was a problem over there. And then for investment banker who advised this, right, got huge amount of bonuses, right? Because the deal was overvalued, and then no matter what, he gets percentage fees coming in. The guy has every reason to inflate that value, right? What's the consequence? The guy later on got promoted in Morgan Stanley, later became the number 2 guy, and then so that's the thing done in Wall Street. So you have to be always careful, okay? 믿을 놈 하나도 없어요. You can trust nobody in Wall Street. You have to be checking everything, right? Checking everything. 믿을 놈 하나도 없다. It's kind of things, right? Anyway, so that's it for today. If you have any questions, email me your questions at the following address over there, and have fun for the rest of the week, and then see you next week. Bye bye.